About 10 years ago, through my research on the S&P 500, I found a small edge and I built a trading strategy around it that I used to trade it manually. The strategy is still profitable today, and in fact, it's still part of a big portfolio that I have that trades automatically today. In this video, I will show you how to find such edges in every market and how to build strategies around it and trade them in a portfolio. If you trade any market enough time and you pay attention, then you'll definitely find some patterns that repeat over time. When I used to trade the S&P 500 manually, I picked up on a pattern that happens about once a month. The pattern that I found is that the S&P 500 usually have a one big range day every month. This big range definition, of course, has many interpretations, but usually it's a big range. You can easily spot it on a chart and you can easily quantify that. So here at the bottom, I have an indicator that plots a bar whenever it finds this pattern. So the way I defined this big range day is whenever the bar range is double the range of the previous bar, plus the same bar is greater than 1.5 times the average true range of the last 20 bars. Once you put that definition in, then we have these bars, and as you can see, it's not every month, but on average it's about once a month. So we can see here, if we focus here, it's clearly that we are seeing this bar. It's a huge bar, and it's of course more than double the previous bar and definitely bigger than the 20-day average true range. We can see here is the same thing, and this one, of course, but then look at this one. This is a big bar, but it's like an illusion. If I actually switch this to bars like these, you can see that this is actually not double as this. So, that's why you need to quantify it, because if you're looking at the chart yourself manually, then you can easily make a mistake. So this is how I quantified the pattern, which is when today's range is at least double the previous range, and also today's range is greater than 1.5 times the average true range of the last 20 bars. And this indicator will plot these stats. So looking at the S&P 500, I have 6,500 bars, and the average range of all these bars is about 23 points. Of course, this will heavily be influenced by the volatility, but averaging all these years is 23 points per day since 1998. And this stats, the event, is the number of big range days depending on this definition. So plotting this definition will give us 230 occurrences that happens in the past 25 years. That comes to 3.5% of all the days. So this is less than once a month. Once a month is about 5.5%. Out of the 230 events that we have, 61 of them, which is 26%, is an up day, and 73% is a down day. So here is something that we immediately get, that most of the big range days are down days. The average bars between events is 26, so that's about 5 weeks of trading days. This is an extremely nice stats, which is if we have an up day, the probability that the next bar is up is 13%. That means if we have a bar like this tall green bar, this is a huge range day and it is up, closing up. The probability that next day is up, it's only 13%, which tells me that there is 87% chance that the next day is down day. So imagine having that knowledge when you are trading. If you have a big up day, yes, it is less frequent. But when it happens, you have 87% chance next day is a down day. So you can short at midnight, you can short at the open, you can short when it breaks the previous low or the previous close or the previous open, because you just want to go short. You're just waiting for anything to tell you, yes, go short now, because we still have 13% chance that it's not going to go down, it's going to go up. But 87, that is huge in any probability book. And let's look at the next stat. And the second bar after the big range up day, it has a 60% probability that it will be up. And that's how you build your strategy around this huge pattern, which is we wait for a big range up day, we short the next day, we go long the day after. And then for big range down days, there is a 30% that it's going to go down the next day. So we still have a huge edge. That is 70% that the next day is an up day. And look at this. There is a 62% chance that the next day also is an up day. So when we have a huge range day that it is down, closed down, then most likely scenario, next day is up and the day after is also up. The chances are 70% next day and the day after is about 60% chance. Still, those are extremely good edges that you can exploit to build your strategy. Now, every market has their own patterns, but this pattern in particular is available in many markets. And we can see, so this is the S&P, and if we go to NASDAQ, we can see almost the same odds exist on the NASDAQ, where 31% of the events are up and the rest are down. Also, look at this. The chance that the next bar is up is 15%. Same thing for EMD. Same thing for Dow. This is soybeans, and we can see soybeans has more up days than down days. But again, we see the flip next day, where the down usually have 80% chance of flipping to up. This is heating oil. On an up day, next day is up, is only 19%. That means, again, you can short the next day. This is crude oil, and we see 35% of the big range days are up days, followed by a down day 81% of the time. This pattern also exists, of course, in stocks. So we can go to, for example, Tesla, and Google, Amazon, Coca-Cola. And you can see in all these instruments that I pull from stocks to futures, they are all usually have the same behavior, where the next day, like if today is a big range day and it's up, usually the next day is down. And the opposite is also true. So now we need to test our theory that when we have a big range up day, we want to short the next day. And when we have a big range down day, we want to go long the next day. We're basically playing the opposite. So let's test our theory and see if we can make a strategy out of it. So here is the strategy applied, and we can see all these days are red, so there are no trades. Only this one is green, and we go short at the open. We close the trade at the close. This is how the performance looks like. And these are the stats. 61 trades making about $300 on average. Now, this is really a good average trade for the S&P 500. That should cover all slippage and commission, and you're still ending up with a good profit. The only drawback of the strategy is the number of trades. So to get more trades in the strategy, we need to ease up on the restrictions. Now, there are only two conditions that we have in this strategy, which is the big range day has to be twice as big as the previous day, and it has to be greater than the average true range. So if I keep only the first part of the conditions, which is the range has to be double the previous range, and I get rid of the average true range condition. Let's compile that strategy and look at this. We went from 61 trades to 198 trades. Of course, that came with a sacrifice, which is the average win went from 300 to about 100. Now, that's a huge drop. So now this strategy is not usable. We need to make it usable. And we can do that easily with a filter. And like I mentioned on this channel many times, a good filter is usually a direction or volatility. So let me use a simple direction filter, which is the ADX. So if the ADX 20 bars greater than 20, we will take the trade. And let's see what that produced. So that bring us back to 65. And yes, it's a better average trade, but you know, we lose all the trade. So let me try something else. So this is now if the close is greater than the 50-day moving average. And that's good. We still have 149 trades, but now our average trade went to $4, which tells me that if I flip this, it should work. And let's flip it, which is now the close is lower than the average 50 bars. We increase our average trade, which is really good, but now we even reduce our number of trades. So again, that is not usable. So now we are back without filters. So 200 trades and 112. And let me use one of my favorite filters now, which is IBS. So if IBS is greater than 85, we will take the trades. And this is, it's like a compromise, but a good compromise. So we almost doubled the trades from the original strategy. So from 60, we went to 115. And we also reduced the profits, but it's a good profit. So 222 on average, that is still very good. And if we look at the equity curve now, it looks like this. And if we look at our annual period since 98, it looks like this. Now, as you saw, every filter works in a different way, especially when they are from different categories like direction, volatility. They will produce different results. And in fact, you can apply a filter on the strategy and take that as a single strategy. And then you have, let's say, 3 or 4 filters producing 4 strategies. And then you combine all these 4 strategies into a portfolio that work as a single strategy. The reason you want to do that is then you can get more trades and they will not be correlated. I mean, they could, but the correlation will be very minimal. So in this case, I will keep, let's say, the IBS as a single strategy. Now we will work on the other side, which is going long when we have a big range down day. So this is the second part of the strategy where we are going long whenever you have a big range down day. So this is one, and this is one, and this is one, and so on and so forth. And we can see we have 164 trades and we are losing. So that means the theory that the next day is opposite, while it's true, we cannot make money with it. So let me try the same concept. First, I will remove the condition for the average true range in order to increase the number of trades. So if I remove that, we compile. Now we have 326 trades. And now if I want to use a filter, so say, for example, I use my IBS again, and if we compile, now the strategy is profitable. So by increasing the number of trades, I have the luxury to add a filter. And now I am making 58 trades. And on average, I am making $366. So now we have 2 parts. One is short, one is long. It's on the same instrument. They will not happen on the same day because it's impossible to have a big up day range at the same time as a big down day range. So we can combine these into a single strategy and let's see what we get. So here are the 2 strategies combined. It's a total of 173 trades and we're making 270 on average. Both the short and long are making good money and we have more trades on the short side. And this is how the strategy looks like, which is really good. We're going up all the time. And if we look at the annual period analysis, as you can see, by paying attention to the market you are trading, you can find patterns and you can easily test them and build strategies around them. To learn more about patterns, watch this video and I will see you there.